Have you ever heard the name Ronald Read? Probably not. He wasn't famous. He wasn't a celebrity. He didn't build a tech startup. He didn't win the lottery. He was just a janitor in a small town in Vermont, USA. He fixed cars at a gas station for most of his life, then became a janitor at a local department store. He wore old clothes, drove an old car, and lived in a modest house. No one ever imagined he had anything special. But in 2014, when Ronald passed away at the age of 92, the world was stunned. Why? Because this humble janitor, this quiet, simple man, left behind $8 million. Let that sink in. No business empire, no viral success, no big inheritance, just smart, disciplined investing over a lifetime. People were shocked. How is this even possible? But those who understood the principles of investing weren't surprised. Ronald Read didn't chase hot stocks. He didn't fall for get-rich-quick schemes. He wasn't a Wall Street genius. What he was an intelligent investor, just like Benjamin Graham describes in his timeless classic, The Intelligent Investor. This book isn't about making fast money. It's about building lasting wealth, patiently, wisely, and with a strong foundation. So if you're someone who wants to grow your money safely, without gambling, without stress, and with principles that even a janitor could use to become a millionaire, then this book's summary is for you. Chapter 1, The Difference Between Investing and Speculating. Benjamin Graham, the father of value investing, starts this legendary book with one of the most important financial truths. An investment operation is one which, upon thorough analysis, promises safety of principal and a satisfactory return. Let's break this down in simple terms. Investing means you do your homework. You understand what you're buying, you protect your money, and you aim for decent, long-term growth. Speculating means you're guessing. You're hoping something will go up. You're driven by hype, fear, or greed, not facts. It's the difference between thinking and reacting. Example, let's say you're buying a car. If you're an investor, you'll do your research. You'll check the engine, mileage, fuel efficiency, safety features, reviews, even the resale value. You're making sure that this car gives you value over time and doesn't break down next month. But if you're a speculator, you might just say, wow, this red sports car looks cool, and buy it on the spot. Maybe it goes fast for a while. But what if the engine fails in 2 weeks? What if the insurance is sky high? What if the fuel costs are insane? Now replace that car with a stock. That's how many people invest today. My friend said this stock will double in a week. Everyone's buying it. I don't want to miss out. It's going up fast. I should jump in now. That's not investing. That's speculating. That's gambling with your hard-earned money. And here's the truth Graham teaches us. Speculators might win once or twice, but over the long run, they almost always lose, because they're relying on luck, not logic. Lesson: an intelligent investor is like a detective, studying the clues before making a move. Speculators, they're like gamblers in a casino, hoping for the best without knowing the odds. So if you want to protect your money and grow it steadily, start thinking like an investor, not a gambler. In the next part, we'll meet one of the most important characters in investing. Chapter 2, Mr. Market, Your Crazy Business Partner. Now let's talk about one of the most brilliant and entertaining concepts in this book, a fictional character called Mr. Market. Mr. Market. Benjamin Graham says, imagine you own a business and every day your business partner, Mr. Market, knocks on your door and offers to buy your share or sell you his. Sounds simple, right? But here's the twist. Mr. Market is moody. Very moody. On some days, he's super excited, full of confidence, and offers you a price way higher than your business is actually worth. Like, hey, I'll buy your half of the business for $200,000. But on other days, he's depressed, scared, maybe panicking, and offers a price that's ridiculously low. Like, your business is garbage. I'll take it for $10,000. So what should you do? Should you sell to him just because he's feeling happy today? Or panic and sell cheap just because he's feeling scared tomorrow? Of course not. Let's use a relatable example. Imagine you and a friend own a food truck. Every day your friend, Mr. Market, tells you what he thinks the food truck is worth. One day he says, bro, food trucks are the future. I'll give you 50 lakhs right now. Next day he says, the economy is doomed. I'll buy it for 1 lakh. Final offer. Do you just blindly agree with him? No, because you know your business. You know your food truck serves quality food, has loyal customers, and has potential. You don't make decisions based on his mood swings. You wait until the offer matches what it's truly worth. That's exactly what the stock market is like. Every day, the market shows you prices. Some are high, some are low, but the market itself doesn't know the real value of the business behind those stocks. Your job as an intelligent investor is to stay calm, ignore Mr. Market's emotions, and only act when the price makes sense. Buy when he's fearful and offering good deals. Sell when he's greedy and offering over-the-top prices. Lesson: the market is not your master. It's your servant. It's there to serve you, not control you. Don't chase hype. Don't panic when prices drop. Think long-term. Focus on value. And always remember, Mr. Market is not your financial advisor. He's just your moody neighbor knocking on your door every morning. Chapter 3. Margin of safety, your financial seatbelt. Let me ask you something. Would you ever drive a car without brakes? Or ride a bike downhill without a helmet? Of course not, right? Because life is unpredictable. A dog might jump onto the road, someone might break a red light, or maybe you just make a small mistake. And if you're not prepared, that one mistake could cost you everything. Now take that same idea and apply it to investing. Benjamin Graham calls this your margin of safety. So what does margin of safety mean in investing? It means don't buy a stock at its full price. Buy it at a discount, below its actual or intrinsic value. Why? Because even the smartest investors can be wrong sometimes. Companies can underperform. Markets can crash. News can affect prices. Mistakes will happen. So your margin of safety acts like your seatbelt. Even if something unexpected happens, it protects you from a big loss. Let's say you calculate that a company is truly worth $100 per share based on its earnings, assets, and growth. Now imagine two situations. You buy it at $100. No safety, no cushion. If the company performs a bit worse than expected or the market drops, you're instantly in loss. But if you wait and buy it at $70 or $80, now you've created a safety buffer. Even if things go slightly wrong, your investment still has room to breathe. That gap between real value and your buying price is your margin of safety. Think of it like this. If a bridge can handle 10,000 kilograms, do you allow exactly 10,000 kilograms of weight on it? No. You design it to handle 15,000 kilograms just to be safe. That extra 5,000 kilograms capacity, that's your margin of safety. Smart investors do the same. They don't buy stocks at their maximum possible value. They buy with a discount to protect themselves when things don't go as planned. Because in the world of investing, nothing is guaranteed, but your risk management can make all the difference. Lesson: don't invest at the edge. Leave room for error. Always ask, what if I'm wrong? And just like a good driver buckles up before starting the engine, an intelligent investor always invests with a margin of safety. Next up, Chapter 4, Defensive versus Enterprising Investor. Now that you understand safety and value, it's time to answer a very important question. What kind of investor are you? Benjamin Graham says there are two types of investors. 1. Defensive investor. 2. Enterprising investor. Let's break them down simply. The defensive investor. Safe, steady, and chill. A defensive investor is someone who doesn't want to take big risks, doesn't have the time or energy to study stocks all day, wants their money to grow slowly but surely, like planting a mango tree and waiting patiently. Example: let's say you're a full-time teacher, or a software engineer, or a student focused on studies. You want to invest, but you don't want the stress of watching the market every day. The defensive approach is perfect for you. You invest in index funds, mutual funds, or large stable companies, like Apple, Microsoft, or Tata. These are companies that grow slowly, but are safe and reliable. You don't need to babysit them. You're not trying to beat the market, you're just trying to ride with it safely over time. The enterprising investor, active, curious, and bold. Now imagine someone who loves finance. Someone who gets excited reading company reports, following business news, and hunting for opportunities. This person is an enterprising investor. They're willing to spend hours researching businesses, analyze balance sheets, look for undervalued stocks, companies that the market has ignored but have hidden value. Example: let's say there's a small auto parts company that's not famous, but has low debt, good profits, and future growth. Most people ignore it, but you study it and realize it's undervalued. So you buy it, and 2 years later, when the market discovers it, the stock shoots up 3x. That's the reward of being enterprising: higher returns. But it also comes with higher risk and more work. You're like a treasure hunter, taking the time to dig deep and find gold. So which one should you be? Graham says, it depends on your personality and lifestyle. If you want peace of mind and don't want to study finance deeply, go with the defensive path. There's no shame in that. You'll still grow your wealth steadily over time. But if you're someone who loves the thrill of research, learning about businesses, and making bold calls, go enterprising. Just remember, both paths can lead to wealth. The key is to be honest about your time, skills, and risk tolerance. Lesson: know thyself. Don't copy others blindly. Don't try to be a full-time investor if you don't enjoy it. And don't be a passive investor if you love digging into data and company reports. Pick the path that fits you and stick with it. Chapter 5, don't try to time the market. Imagine this. You're standing under a tree. A sharp knife is falling from above. Now someone says, catch it, but only when it's just about to hit the ground. Would you try? Of course not. Because even a small mistake can cut you badly. That's exactly what trying to time the market is like. The myth of market timing. Benjamin Graham clearly warns us, you can't predict the stock market. Not even the experts can. Yet, so many people try to do this. I'll wait for the crash, then invest. It's going up now, I'll sell at the top. Let me buy this stock, it's going to explode. But guess what? Nobody knows when the market will go up or down. Not you, not me, not even billionaire fund managers. Sometimes it falls for no reason. Sometimes it rises even when the economy is struggling. It's emotional. It's unpredictable. It's Mr. Market. Remember him? Being moody again. Real life example. Let's say you had $10,000 to invest. You wait for the perfect time, thinking, I'll invest when the price drops. But the price never drops. Instead, it goes up. You wait more and more, and end up doing nothing. Now imagine your friend invested $1,000 every month, no matter what. Sometimes they bought when prices were high, sometimes when prices were low, but after 2 years, they've invested consistently and built wealth, while you're still waiting for the perfect moment that never came. The smarter way, dollar cost averaging. This is the method that Graham supports. It's simple. Invest a fixed amount every month, no matter what the market is doing. That's it. 500 or 10,000, whatever you can afford. Do it regularly. Don't try to time the market. Over time, this method automatically balances out your investments. Some months you'll buy more when prices are low. Some months you'll buy less when prices are high. But you remove emotion. You stay disciplined. And that's what creates long-term wealth. Lesson: consistency beats timing. Think of investing like planting seeds. You don't wait for the perfect rain to start planting. You plant regularly, water consistently, and watch your wealth grow over time. Even Warren Buffett says, the best time to invest was yesterday. The second best time is today. So don't waste time guessing the market. Be consistent, be patient, be smart. That's what separates the intelligent investor from the impatient gambler. Chapter 6, Emotional Discipline, the Real Secret. Imagine you're on a roller coaster. At first, it's fun. You're going up, excited. But suddenly, it drops fast. Your heart races. Panic kicks in. You scream. Now think of this. The stock market is the world's biggest roller coaster, and your emotions are the passengers. Benjamin Graham says, the investor's chief problem, and even his worst enemy, is likely to be himself. Let that sink in. The real danger in investing? It's not a bad company. It's not inflation. It's not market crashes. It's you, your own fear and greed. What happens emotionally? When markets go up, you feel excited. You hear stories, this stock doubled in 2 months, and you jump in at a very high price. Greed drives your decision. When markets go down, fear kicks in. Headlines scream, biggest crash in a decade. You panic and sell at the worst possible time. This buy high, sell low behavior, it's the opposite of what you should do. And yet, most people do exactly that. Real life example, the 2008 financial crisis. In 2008, the stock market crashed. People panicked. News channels showed red arrows and falling numbers all day. Millions of regular investors sold everything, thinking, I've lost enough. But guess what? Those who held on, or better, invested more during that panic, became millionaires in the next 10 years. Because markets recovered, slowly but surely. Emotional discipline, superpower. Being an intelligent investor doesn't mean having secret formulas or stock tips. It means staying calm when others panic, being rational when the crowd is emotional, controlling your impulse to react. That's the real edge. Because you can't control the market, but you can always control your response. Quick mental trick. Next time the market drops and you feel scared, ask yourself, if I like this stock at 100, why am I scared when it's available at 70? Would you get scared if your favorite shoes went on sale? No, you'd probably buy more. Treat good stocks the same way. Lesson. Emotions can ruin your wealth faster than any crash. Don't make decisions in fear or excitement. Stick to your plan. Trust your research. Think long term. That's what separates gamblers from intelligent investors. Chapter 7, invest in what you understand. Let's say someone tells you, hey, there's this hot new company using quantum blockchain AI to decentralize the metaverse. Sounds fancy, right? But what does that even mean? If your honest answer is, I don't know, then stop right there. Benjamin Graham says, never invest in a business you cannot understand. Why is this so important? Because if you don't understand how a business works, you won't know whether it's actually making money, if it has long-term potential, Or if it's just riding a temporary hype wave, and if things go wrong, you won't even know why they went wrong. You'll just panic and sell. Simple example. Imagine you're buying a food truck business. Now, you love burgers. You've eaten at many places. You understand what makes a good burger and what customers want. So, investing in a burger food truck makes sense. But now someone says, let's start a business selling exotic mushrooms for biotech use in Korea, and you've never even seen that market. Still going to invest? That's called blind investing, and it's dangerous. Warren Buffett's golden rule. Warren Buffett, the most successful investor in modern history, follows this same rule. In the early 2000s, everyone was going crazy over dot-com startups. Buffett stayed away. Why? He said, I don't invest in what I don't understand. People laughed at him, said he was old-fashioned. Then the dot-com bubble burst. Tech stocks crashed. Many went bankrupt. Buffett? He survived, thrived, and kept building wealth, slowly and wisely. The crypto example. Now think about cryptocurrency. Yes, some people made money, but many who invested without understanding lost everything. They just heard buzzwords like Bitcoin, blockchain, moon, and thought it was a golden ticket, but they didn't ask. What is this tech solving? How does it make money? Is it sustainable? If you can't answer those, you're not investing. You're speculating. Lesson: understand the business or walk away. Before putting your money into any stock or company, ask, what does this business do? How does it make money? Is its future predictable? If you can't explain the business in simple words, don't invest in it. This one principle alone can save you years of regret and thousands of dollars.